Hello friends, we'll discuss a new topic today, that is methods of preparing trial balance. Along with the methods, we'll also discuss what is the difference between revenue and capital expenditure. These two are very important topics for us and every account student should know about these things. So first we'll talk about methods. First method that we have in the list is the balance method. In this method, balance of every ledger account, it may have a debit or a credit balance. It is recorded in the trial balance. So any one balance is recorded. Okay, balance is always on the one side. So we record only one column. This method is widely used as it helps in the preparation of financial statements. Second method is the total amounts of the credit side and of the credit side, they both are recorded in the trial balance. But this method is not commonly used and it does not help much in the preparation of financial statement. In financial statement, I cannot use this information. So therefore, this total method is not widely used. There is third method also, that is the combination of these two methods, total and balance method. So this is a combination in which we have all the information. We have four columns here. We have total of debit side, we have total of credit side, and then we have debit balances of ledger accounts, we have credit balances, and this method is also not much in practice now. So we have only one important method to focus here, that is balance method. Now how do we record, how do we prepare balance method? First, calculate the balances of all ledger accounts including the cash book. Record the names of the accounts in a particular column and the amount of debit balances in the debit column and credit balances in the credit column. Enter the page number and then debit and credit columns are total. Their sum should be equal. They should be equal. If they're not equal, that means some errors are there, and then you need to find out those errors, locate those errors, and then again trial balance has to be prepared. And every time, always, at every cost, trial balance should agree. If it does not, that means there has been some error that is not identified. So this is how a trial balance look like in a balance method. Since we are writing only the balances, so we have only one amount here. So cash generally has a debit balance. We all know what kind of balances they have. Capital has a credit balance. Furniture has debit balance. Purchases account also had debit balance. So we have only balances here, and when we write down all the accounts and their respective balances, we total these two sides. Every time these sides should tally, or we should have the same total. Here total is 6,31,000, 31,800. So whenever this total is not tallying or there is some discrepancy, it means some error is there, either in journalizing or posting or carrying amount to the trial balance. Some or the other place there is some error. So that error has to be identified and rectified as soon as possible. We cannot take these errors to the financial statement. We prepare financial statement only when we have reached this step where debit balances and credit balances match with each other. Okay, so this is the widely accepted method, trial balance under balance method. We have totals method also. I told you it is not much in use, and but how do we prepare? Let's take a look of this. Calculate the total of debit side and credit side of all ledger accounts including cash book. Enter the name of the account in the particulars column and enter the debit total in the debit column, credit total in the credit column. Enter the page number, find out the sum, and again if they are not find out both the column total. If they are not tallying, this means some problem is there. So trial balance must always agree. So this is how a trial balance under total method look like. Every account has debit balance also, credit total also, and debit total also. This has only one entry, so it has only one amount. Furniture account again. So wherever possible there is a debit side or a credit side, total of both the side is recorded. Time and again we have discussed that this trial balance is not very helpful, so it is not in practice now because we are not able to prepare our financial statement using this method. This is not used. Similarly, this is a method where we have both total cum balance method. This is also not used. So we have 4 columns here. This is debits total, credit total, then we have a debit balance or a credit balance. Any one balance would be there. So it is the summary or combination of both the methods. These 2 columns we have in total account, these 2 we have in balance method. So in this we have all the columns, but again this is not used. So students will be tested only on balance method. These 2 methods are not in use. We don't make these trial balances, so we make trial balance only using balance method. That is only helpful for us. Fine. So what are the major differences? Why one method is so much in use and other method is hardly used? So what are the differences? Let's have a look on these differences also. So first we'll talk about balance method. This is the most important method. It can be prepared after all the ledger accounts have been balanced. I need to find out the total, proper balancing figure has to be there, then only I can prepare trial balance using this method. It can be prepared immediately after the completion of posting from books of original entry to the ledger. Here balancing is not required. I'll just total both the sides and I will write down. It shows the balances of all the accounts in the ledger. It shows the total amount of debit and credit side in each ledger account. It considers only those accounts which show a balance. If an account does not have any balance, it will not be considered. If any account has a zero balance, it will not be carried to trial account. Trial balance will not have any account whose balance is zero. But in case of this method, totals method, all the accounts are entered in trial balance, whether they have negative balance or zero balance or any other case. Okay, so this is all about the methods. Next we'll talk about capital expenditure and revenue expenditure. Now every organization, every company, every firm, there are several kinds of expenses that we are incurring. Okay, so what we are doing is we are dividing these expenses into 2 categories. First category is revenue expense, other category is capital expense. First, let us explore something about revenue expenditures. What are revenue expenditures? They are short-term expenses. They are short-term expenses used in current period or typically within 1 year. So whatever expenses we are incurring in short term or for 1 year only, they are known as revenue expenses. They are required or they are incurred to meet ongoing operational cost of running a business. So they are expenses that are required for day-to-day functioning of the business, and they are also known as operating expenses. So this is the short form of operating expenses. Revenue expenses also include ordinary repair and maintenance. Why? Because they are important, necessary to keep an asset in working condition. Okay, when we are not improving or extending the useful life of an asset, ordinary repair, greasing, oiling work is done, that falls under the category of revenue expenditure. Revenue expenditure relates to existing assets. It includes repairs, regular maintenance as well as repainting and renewal expenses. Revenue expenses can be considered to be recurring expense. Recurring means the repeat. Every year you are making these expenses. Every year you are getting your machinery serviced. Every year you are getting some greasing done. So these are expenses of recurring nature that happens time and again. In contrast to nature of most capital expenditures. Now here are some examples of revenue expenditure. First is salaries and employee wages. Every month or every fortnightly we are paying some wages. It is a regular feature. So these expenses are known as revenue expenditures. Any overhead expenses such as salaries of corporate office, which typically fall under selling, general and administrative expenses. Research and development that is going on at a regular course of time. Utilities, rent, business travel, taxes, these all are expenses of repeated nature. Every year we are making these expenses. So these are revenue expenditures. Next we'll talk about capital expenditures. Now they represent significant investments of capital that a company makes to maintain or expand its business or generate additional profits. So whenever you make more capital investment, that is not done regularly. Okay, so this becomes capital expenditure. Now capital expenditure may expand your business or it may help in creating additional profit also. Capital expenditures consist of purchase of long-term assets. What are long-term assets? That last for more than 1 year, or they may have useful life of many years. For example, you are purchasing a heavy machinery. It may have a life of 10 years. Capital expenditure are often used for buying fixed assets, which are physical assets such as equipment. As a result, capital expenditure are typically for larger amount than revenue expenditures. They involve a bigger amount of investment, heavy investment. However, there are exceptions when large asset purchases are consumed in a short term or current accounting period. Now types, here are few examples. A facility or factory including an upgrade or expansion. Whenever you are purchasing new factory or a facility or a plant, it leads to upgradation or expansion. So these are examples of capital expenditures. When we purchase some vehicles such as truck used for delivery of products, again it is a kind of expansion. It is a capital expenditure. Manufacturing equipment, again it is a part of capital expenditure. Computers, furnitures, etc. These all are capital expenditures. They have life of more than 1 year, or I may say they are long-term assets. Okay, they may not be of recurring nature. So these are known as capital expenditures. Now we have understood that these are the two basic type of expenses. We are dividing most expenditures into these two types. What are the major differences between the two? It becomes essential for us to know these differences also. Let's quickly look at these differences. First is capital expenditures incurred in acquiring or improving permanent assets not meant for resale. Now, not meant for resale means we are not into trading business of these machinery. We have purchased these assets, or we are acquiring or improving these assets for beneficial, for increasing our profit capacity, for increasing our profit. They may add value to an existing asset. On the contrary, revenue expenditure is a routine expenditure incurred in the normal course of business and include cost of sales and maintenance of fixed assets. Capital expenditure increases earning capacity. When we are making more investment into the business, obviously we want to increase the capacity, we want to expand our business. Whereas revenue expenditure maintains the earning capacity. Third, it is normally a non-recurring outlay. I may invest in the business today and I may make other investment after 5 years, after 10 years. So it is not recurring in nature. Whereas revenue expenditure is recurring in nature. Every month you are going to pay salaries. Every time you are going to pay rent of the factory services that you are using. So these are the expenses that are recurring in nature. Next, capital expenditure produces benefit over several years. Investment that you are making, assets that you are purchasing, they are used for long time. So they give us benefit over several years. Thus, a small part is charged to income statement as depreciation and rest appears in the balance sheet. And if we talk about revenue expenditure, it is consumed within an accounting year, that is benefits only for 1 year. Thus entire amount is charged to income statement, it does not appear in the balance sheet. Capital expenditure, it is an item of balance sheet, whereas revenue expenditure, it is shown in trading and profit and loss account. So these are the two major types of expenditures. You may talk about any expenses, try to think on these features whether it is capital or of revenue nature. So this is all for this video. Thank you so much.